Well, good morning. My name's Jeff Miller, CEO of Synchronoss Technologies. I'm joined by Lou Ferraro, who's the CFO of our firm. We'll give you an opportunity to get acquainted with us, but summarily, we're a software solutions provider that provides cloud communications solutions to very large global service providers. So our customers are familiar names like Verizon and AT&T in the United States and SoftBank in Japan as a few key examples. Of course, we'll make some forward-looking statements along the way. We just concluded our Q1 earnings report, but we'll talk to you more about introducing you to Synchronoss and our business today, and the financial operations of the business in total. Our company, including our leadership team, are a reflection of the customers that we serve. We have all worked for many years, in some cases decades, in the communication service provider category. Both Lou and I have worked at AT&T. Lou's also worked at Verizon. I, when at Motorola, served AT&T and Verizon. We speak the language of our clients. We understand the business operations that they have, what's important to them, and we are a microcosm of our broader leadership team. That's important because the relationships we have with our clients are very long-term in nature, and that'll become evident through the course of the presentation. So what do? We are a software provider for a value-added service that is known as a cloud offering. Now, cloud means a lot of things to a lot of people, but in our case, we provide a personal cloud solution that our customers resell with their brand names applied to it. So we come to subscribers and we come to the marketplace as Verizon Cloud today, or AT&T Cloud, or in Japan, we're known as Anshin Data Box, which is Japanese for peace of mind. So our solution digitally protects content that's created by consumers, their photos, their videos, their music, their files. But in addition to that, we can create engagement with that content, allowing and inviting a consumer to interact with it such that they get more endeared to that relationship with their service provider, and they want to share that digital content with others over time. The reason we are relevant is because we generate large-scale revenues for our clients. We've generated over $3 billion in top-line revenue for the communication service providers that we serve. Last year, in their public filings alone, Verizon revealed that they generated $600 million in 2024 for Verizon Cloud. So this is not a small business for them. It's a healthy margin business for them. AT&T is on a rapid growth path to be the next Verizon in our portfolio, and SoftBank just launched at the end of 2023. Every day, we add 50 million new photos to our library that we digitally protect and make sure that are secure from any violation. Today, we have over 11 million subscribers across our customer base utilizing our platform. So we've created critical mass. And in a white label basis, because we apply the customer's brand to the solution, we are the largest white label service provider for cloud solutions anywhere in the world. The customers that we represent by the logos you see below here, not just Verizon, AT&T, but they're prepaid brands of TracFone or AT&T Prepaid or our insurance client Assurant. These are some of the largest companies in the world that represent themselves to their subscriber base, and they represent over 400 million subscribers globally. And with only 11 million currently under our subscription, we're only 2.5% penetrated, so we have significant opportunity for growth as we further penetrate the subscriber base of our current customers. Now, on a financial basis, we just concluded our Q1 operating earnings performance. We generated $42.2 million in revenue. That was driven by 3.3% subscriber growth on our 11 million subscribers, and we grew our EBITDA performance by 17% on a year-over-year basis. What we've also done, by virtue of this subscription model that's offered by our customers to their subscribers, and then we participate in it, 93% of our revenues in Q1 were recurring revenue or subscription-based revenue. That's actually on an incline. It's been the highest level that it's been in years, if not maybe even in the history of the company, but it provides us good, solid visibility to the revenue and the projections that we have on a go-forward basis. And because we have long-term relationships with very large customers like Verizon and AT&T, we're pleased to say that over 90% of the revenues that we're expecting in 2025 are under contracts of 3 or more years. Now, we've been working at this for a while to get to the point where our financial performance is what we just delivered and on a trajectory to continue. We had a vast portfolio of software products within the Synchronoss family, and the company's been around for 25 years. But in the last 4 years, we have focused on our cloud solution, doubling down our R&D investments in this category, optimizing other product lines for sale, and we divested them. So we began 2024, and 2024 was our first operating year as a pure-play cloud solutions business, and it delivered. We delivered 5.9% revenue growth on a year-over-year basis. That focus allowed us to sign up further contracts and extend our relationship in the fourth quarter with AT&T for another 3 years, sign up our new contract with SFR for another 3 years, and we've got contracts in place with Verizon that goes all the way to 2030. So we've put ourselves in a position to have an exceptionally strong foundation for the business, and we've improved our operating performance such that our EBITDA margins now are 30%, both for Q4 of last year and Q1 of 2025. Now, the backdrop industry that we participate in is one that is also a tailwind. We continue to see individuals and families capture a proliferation of more digital content that they want to share and they want to interact with. And as a result, more content is being stored, and people are gaining greater confidence that they can put that content in the cloud and feel comfortable that it is secure and protected. In fact, the relationship that a service provider like Verizon or AT&T has with its subscriber puts them in a tremendous position to be a trusted partner, potentially even more trusted than a relationship with Apple or Google, because people are not quite sure how those content that they might store with those firms is being monetized or used for advertising purposes. As a result, we are finding ourselves in a situation that the cloud segment is growing, the digital content library is growing, more people are using multiple clouds, as some of the statistics that show here, but not everybody is backing up their content. So there's a lot of consumer decisions yet to be made on where digital content will be stored. And on a global basis, we're seeing price increases from companies like Google that are only putting the operators that we support in a better competitive position to create a very compelling value proposition. I mentioned AT&T, Verizon a little bit more, SoftBank as a reference, but the entry for our business into SoftBank was a major milestone where we had done work in our former messaging business in the Japanese market, but we leveraged those relationships to expand into the cloud marketplace in 2023, launching in November of that year Anshin Data Box, an entirely new community of subscribers, over 50 million in the mobile space alone for SoftBank, and we've just begun to penetrate that subscriber base. Another avenue for long-term growth. So what our solution does, it creates a visually interesting and engaging and inviting interaction with your digital content. It's your digital content. It's the personal consumer-generated content. And as a result of that invitation, we're seeing tremendous amount of take rates for people who want to do the storage and backup. But further, we want to see, and we are seeing more people who want to interact with it. And in our case, the reason we differentiate ourselves from an Apple or a Google is because we're agnostic to the operating system. So we will capture content from Android devices, Apple devices. We're also independent of the device itself. So we've got tablets, computers on a desktop basis, your mobile device, the most interactive solution. Any of those can be utilized to both back up and store and access your digital content from anywhere. And if you have a family that might be what we refer to as a bit of a mixed OS family, where you have some members at iOS and some members with Android, that's fine. You can share a library of your digital content across all those operating systems, which is not something you're going to be able to do with Apple or Google. You also have the opportunity within that folder to capture a certain segment that is protected at an even higher level. So we provide the capability for a private, password-protected or biometrically protected folder of your digital content for things like medical documents, your mortgages, maybe your trusts, whatever the case might be, such that you have the ability to say, I want all this content shared with everybody in my family, but this is my own personal repository. And that kind of digital protection is something that's increasing in importance as cyber attacks and cyber security become a higher and higher priority for consumers and businesses. Now, I want to give you a quick introduction of what it looks like. So if you can take a look at the screen, this is what a subscriber gets as an invitation to interact with their AT&T cloud. If you power up an Android device, let's say you just bought the latest S25 from Samsung, you will be invited into a trial to utilize AT&T Cloud in your digital setup. So it is a curated walk digitally to introduce you to the service. And then once you're done so, you have the immediate opportunity to personalize that experience. Sure, put your name on your cloud. Then you can select your own personality of your own photo. Then you get to select what content classes you want backed up in your cloud. In this case, we want contacts, I want photos, I want videos. Then we immediately begin to take that digital content from your device and back it up in the cloud. So you could easily leave your device on the next taxi ride you have in New York, but your digital content is always something you can go back to and get, even if you can't find your phone. Once you're in that situation and that content is backed up, especially with the proliferation of content, it's critical that we put you in a position to be able to find the photos or the videos you want when you want them in that vast library. So we provide you tools to be able to access and classify that information into albums, making it simple for you to see where your content is and interact with that content. But we don't wait for you to go and find it. We'll actually proactively engage with you and invite you back to a memory of the trip you just took. I was just in London last week visiting with clients. And by the time I got home on Tuesday this week, I got a notification, the best of last week. And it showed me walking through the Borough Market in London and the St. Paul's Cathedral where I was at my hotel. That's just a quick reminder of what you did last week and brings it back into a curated library of items that I might want to then share and convey to other people. Now, it's one thing to digitally protect the content and utilize machine learning as a means by which to statistically present back the most logical data that you want to interact with. But we go beyond that. In the world of artificial intelligence, we provide you tools of generative AI so that you can create and modify photos that you might have taken years ago. You can colorize a black and white photo, or you can turn an anime image out of a photo that you've taken of your family members, again, years ago. Creating a little bit more interesting, more current content from something that might have been captured and forgotten a long time ago. Putting tools in the hands of our consumers is a way to get them to engage more with the app, get them to keep them stickier to the application itself, and to the brand that they are using it through, Verizon or AT&T or SoftBank. Now, as we communicate on the digital onboarding, as I described, and we have a vast number of ways to interact with consumers such that they have the ability to see and get introduced to our application. So it's not just on the powering up of a new Android device, but it's in the retail store with our sales associates from Verizon and AT&T representing their branded cloud content as they get you subscribed or upgraded to your latest device. We also work through their customer care channels, their digital channels, and their My Account applications. And we just updated and tightly integrated our cloud solution at Verizon into their My Verizon application, which is essentially omnipresent across all of their subscriber base. This provides us discoverability opportunities and the ability to accelerate the continued subscriber adoption of our platform. And these business models work, and they work well for our clients. And as such, we have expectations that we're going to expand our reach beyond the customer base we have today and bring more clients onto this platform, further contributing to our growth and our subscriber growth. So with that, let me turn it over to Lou, who'll get you introduced to the financials.
I'll let you click, sir. Thank you and good morning. Let's take a look at our results at Synchronoss for the first quarter. As Jeff mentioned, a strong quarter supported by 3.3% subscriber growth, building on our 11+ million subscriber base, supporting our B2C2C model that we have as a software as a service provider. We also saw a continuation of the momentum with carriers who are trying to improve their average revenue per account, of which we are a critical component of their value-added service revenue. That resulted in very strong GAAP gross margins of 70+%, adjusted GAAP margins of 79+%, and most importantly, a 17% growth in EBITDA to $12.7 million and a 30% EBITDA margin. Next. We've been setting the stage as a pure-play cloud provider to continue to improve our performance financially as we continue to move our profitability forward and becoming a positive cash flow generating company. This chart just indicates our EBITDA growth and how we've done that. And it's really been a succession of 3 steps. In the commoditization of the hosting area, we decided in 2018 that we were not going to be able to compete with the likes of Amazon, Microsoft. We got out of managing our own data centers and went to the large service providers to take advantage of economies of scale. Then, after divesting our digital messaging and network businesses, we immediately then went to and said, we have to have a business model that supports a cloud-only company. So we took extreme measures at the end of 23 and some smaller measures in 2024 to improve our cost structure substantially, taking a number of folks out of the business, renegotiating contracts with vendors, and that put us in place for the EBITDA margins and the improvement in EBITDA that we're seeing today and that we will see continuing into the future. Next. When we turn to guidance for this year, you'll see our revenue of 170 to 180, EBITDA from 52 to 56, and GAAP free cash flow of 11 to 16 million. A comment on revenue. If you look at our performance and what we've disclosed in our annual results for 2024, we had about $8 million of that revenue of 173.6 that doesn't recur this year. $2 million of that was related to the continuation and finalization of our professional service work with SoftBank. And then we had British Telecom, who had been a customer for 8 years. Our cloud product, though, was supporting a legacy landline-based product that they decided to sunset. Had nothing to do with our product. They just said, we're eliminating that business. So on a pro forma basis, if you look at that, our revenue would have been 165 last year. We're getting that back into the $170+ million range this year. The last thing I want to mention on this slide is we are right now in the position where on our balance sheet, we have a $28 million receivable from the IRS plus the applicable interest. This dates back to the CARES Act that the Trump administration put in place in their first tenure in office. We filed for $42.3 million of refunds. We expeditiously paid $14.3 million. That $28 million has gone through all the phases of review at the IRS. We've been notified in writing that we will be paid the $28 million plus the interest. Now we're just, quote, waiting on the check. Next. As we look ahead for a company, we're poised to continue on a revenue growth curve, a profitability curve, and improving on cash flow generation, which are the 3 things that our entire company is aligned to support our customers and our shareholders. And as you can see, our 2-year to 3-year targets are to achieve that double-digit revenue growth. That'll come from our existing customers, signing on new logos, improving our EBITDA margin to 30+%, and again, improving on our free cash flow. I'll turn it over to Jeff for a wrap.
Great. So it's been quite a journey. Some of you we've met in the past and told you the business that we were trying to build. We have delivered on that with the trajectory of the business from 2024, now entering 2025. Q1 was just further evidence that we are continuing on a solid path going forward. We've got excellent foundational contracts in place with our customers. We are relevant because we drive revenue and margin for them. That keeps us relevant every day. We also improve their churn. And anything that contributes to lower churn of someone going to somebody else is of tremendous value to some of these very large companies. As a result, we feel like we're in a great position. And we have a proposition and a set of reference points that will allow us to replicate this with other clients around the globe. So we feel as if we are in a great position for the future. We're delighted on the fact that we're now driving cash flow on a positive basis. We've got a tremendous visibility on our capital structure all the way through 2029, and that puts us in a position where we think we're in a great spot to win. We're happy to take any questions if you have them. But thank you very much for your time. Yes?
Could you update us a little bit on the balance sheet, just from a debt standpoint and total cap structure?
Absolutely. Yeah, I'll ask Lou to go ahead and do that. Thank you.
Sure. In April, we concluded a $200 million term loan led by Birch Grove, or AP Birch Grove, now that they've been acquired, TP Birch Grove, excuse me. We had a debt structure prior to that had about $121 million of senior notes, a $75 million term loan that we put in place last June. We wanted to make sure that none of that got to the standpoint that it would become current. And so we eliminated that, put a term loan in place at SOFR plus 700 basis points. We'll improve that immediately, though, once we get the IRS refund. By obligation of that term loan, we're going to put 75% of the proceeds to take that down. So that should take the term loan down by about $25 to $26 million, which will bring us a corresponding interest reduction of between $2.2 and $2.4 million.
And the WACC on that?
It's SOFR plus 700 basis points, so it just puts us just under 11% right now. Yes, sir.
Can you talk about the visibility you have on guidance and maybe how recurring your revenue is?
I'm sorry, Ray?
Talk about your guidance visibility and your revenue, just what percentage is recurring?
Yes. So on a guidance basis, revenue of $170 to $180 million with greater than 90%, as we recorded in Q1, 93% recurring, and that's based upon the stability of those large contracts that we mentioned with Verizon, AT&T, SoftBank, SFR.
Do you have any contracts that sort of run into the B2 scenario where they were, it's just like an older service being provided, whether or not it's with Verizon Home or whatever?
It's a great question. No, the BT circumstance was one we saw coming for quite a while as a result of the fact that it was truly wireline oriented. Now, there was a reason I was in London last week, and it was to continue to visit with them. Now, they have retooled their entire business at BT. They have a new CEO, a new head of commercial, consumer, and so forth. There's a whole new chapter to be written in our relationship with BT, we hope. But none of our other contracts have any kind of exposure like that, because we are primarily a mobile-driven business. Our relationships with all of our key customers, as we've mentioned, have very long tails to the contracts that are in place. The AT&T was probably the most recent one that was further ratified, if you will, signed in December of last year for the next 3 years. So we are in very confident position with the customers that we have and the platforms that we serve. And it is a combination. You mentioned Verizon Home. We're in Verizon Home. We're in Verizon Mobile. We're in Verizon Small Business. We're in Verizon Value, which is their prepaid segment. So we've become quite pervasive with the customers who are leveraging the platforms that are already in place.
And just a follow-up question on the customer, because it seems like, through the competition among just even wireless providers, deals being offered, is the data, the cloud information on a personal basis transferable? So say I sign up with AT&T and I've been a Verizon wireless, which is exactly why they're hoping that
The cloud will keep them there, right? Yes.
I mean, but is that ultimately a transferable data set?
It takes some lifting by a consumer. It's not easy to extract your content from one cloud and move it over to another. That creates some of the stickiness, and that's really part of the entire proposition. And from a consumer standpoint, you probably don't want to risk it, because while you just paid $1,100 for your latest phone, the memories that you've captured for the last 10 years are probably worth a lot more. Any other questions? Yes, please. Delighted to have you.
So as
Jennifer, keep
so
going.
as you continue to work through improving financials, you've gone through a lot of effort to get to this sort of clean business model. Are there, I mean, if we look out 3 to 5 years, is the goal just increasing the customer base? Is it different kinds of services? Is there anything you can talk about that, how you think about the evolution of the business and in particular return on capital to investors, or
Yes, absolutely. So first, I'll start with the multiple growth vectors we have as a business. The first and most logical is continued growth and adoption of our current subscriber base. That's blocking and tackling. Next is to add other customers to this platform and replicate the business model that we've had in place with Verizon and AT&T and others. And that is something that we've said this year. We have an expectation that we'll sign at least one new customer during the year. Beyond that, we are now in a position to be a little bit more offensive because we've got cash that we can start to invest. So we will selectively, keeping cloud as the centerpiece, look for adjacent or complementary service offerings that can go and add new service revenue generation items for the cloud, like maybe taking further steps to protect your personal identity. That could go right along with the digital content that we already have captured in the cloud. Plus, we have 11 million subscribers. We think we could cross-sell some other products to them that might, again, be closely aligned. And while we're the largest white label service provider in the world, we're not the only one. There could be potential for selective consolidation that could get us access to more customers, more geographies, and leverage the infrastructure we already have in place. We're also starting to invest our own talent into looking at new ways we can add further innovations onto our platform. So we have right now about 4 or 5 different vectors for growth that we're looking for. Some of those would be organic, some of those could potentially be inorganic, but again, on a very selective basis because we're just now to the point where we're positively generating cash flow and we're going to keep that train rolling. Okay, I'd like to thank you all for your time. I'm sure we have to move on to the next segment. Have a great rest of your day.